Hello, everyone. I hope you're doing well. Today, we're going to be discussing the major advantage of life insurance companies in general that makes them far more attractive than, ETFs and mutual funds and stocks and the whole nine yards for investing money in general, along with safety. Before I begin, I don't claim to be an expert. I'm not a life insurance advisor. I'm not a financial advisor, nothing like that. I'm just a personal finance enthusiast. Please like the video, subscribe to the channel if you are interested in alternative finances or finances in general. I know we're stuck on IBC right now, but we're going to be talking about all kinds of topics as this channel evolves. And comment below if you agree with me or disagree with me. I love having the discussions. If you disagree with me, expect a reply back, and we'll have a good conversation about it. I don't claim to know everything, and I have had my mind changed a couple of times, so we'll go about it. So let's look at why insurance companies have a major advantage over the average consumer. Because the argument that I get all the time when I say, hey, I'm investing in my life insurance and it's projected to earn, say anywhere from a 3.5 to, say, a 4.5% rate of return on whole life. When it's properly structured, high cash value. And people go, well, that is crazy. The stock market's going to average, 8 to 10% a year. So, first, we're going to look at the stock market, and the reality of it is this 8 to 10% rule. I don't want to necessarily say if it's right or wrong because I haven't looked at the long-term trend data myself. But let's say I agree with this statement that over the past 100 years, the stock market has gained 8 to 10%. Now, there has been studies, and I've cited them in different videos. I'll try to remember to link to that show that the average investor, I think, is earning approximately 2% on average, so substantially less than 8 to 10%. Now, why does this happen? Well, let's consider the average life of an individual. So, first, we're going to talk about the risk profile of an individual. And then we're going to talk about the wealth accumulation of the individual. And I'm not necessarily going to add in, real estate and all that type of stuff here. We're going to talk primarily about stock market returns because that's what everyone compares this 4.5% rate of return to. So typically speaking, as people, so risk and age, as people are younger, their risk profile is relatively high. And over time, the risk profile goes down. And it kind of hits a rock bottom where they need to retain as much capital as possible. Now, when I say high, high is typically, equities. So, the general rule of thumb ends up being 100% minus your age, ends up being how many equities you hold. If I recall, let me know in the comments below if that's right. But that's what I do recall. And so, for example, you're 20, you should be in a portfolio, 80, 20. And then as you gauge to 30, 70, 30. Then as you're 60, it should be 40% equities, 60% bonds, and so on and so forth. And the idea is as you age, you take less risk. Now, the problem with this, when you start looking about the wealth that is accumulated in the age of an individual, people often start at a negative position. Right? Where are you going to start? People start at a negative position of equity, and then over time, certainly things compound. But then what ends up happening? You compound your wealth, and then you need to utilize your wealth. Now, if you've planned substantially well, what's going to occur is you're going to be able to potentially just increase your money. Maybe it'll stay the same, but I think for most people, what ends up happening is your wealth will decrease. Now, this isn't necessarily a problem per se because it can be a planned endeavor and it can be an expected event that occurs in life that you utilize your wealth, of course, right? But when you're comparing this to saying that you're going to get an 8 to a 10% rate of return, it's just simply not true because this 8% return is based upon a 100% equity position in the stock market, which is not what traditional financial advising recommends in any capacity. Um, the last white paper I read, I think, estimated long term mixed profile. So when you talk about equities and bonds together to be around the 6% mark, if I recall, might have went as high as 6.5. So remember, you're starting to bridge the gap significantly between, annualized average rates of return versus our whole life. So here is the issue with the stock market for an individual and the risk. So first of all, you have your individual risk profile that decreases as you age. You want to preserve capital in retirement versus your wealth accumulation phase, right? And the truth of it is that when you talk about an insurance company, the reason why they are able to remain so safe is because they don't care about this risk profile, and they do not have a defined timeline of, say 80 to 100 years of life. The insurance company is designed to last in perpetuity. So, this isn't to say that life insurance is invested in an 80 to 20% equity position, because they typically invest into a lot of low risk endeavors, but they also do, a lot of private lending for commercial mortgages and all that type of stuff. But when they're investing, they simply say we are acceptable taking a risk of X, whatever that may be, and this risk simply remains the same. Period. Now, of course, with capital fluctuations, high mortality, they may have to decrease this slightly. But unlike a human that has a finite period of life that has to decrease it forever, once they solve this problem, it can go back up to where it needs to be. And so, what this means is that over time, they'll actually obtain this 8 to 10%, whereas the average individual, because of the composition of equities and bonds, will never get this 8 to 10%. And then they don't have to worry about capital preservation in the same way that the regular individual does. So they can go out and they can earn an 8 to 10% rate of return on the long run. And this is what insurance companies do. They do smoothing effects, right? So in the years that they earn, say, I don't know, say a 20% return, they're still only paying out this dividend that they're paying out, right? And so they're retaining it, so that the markets that go down, say minus 10%, they're still paying out this money. It's a topic for another video. But the point is, life insurance companies are tremendously safe because they're paying out, so their payout is down here. This is their profit. And it's also their risk, of course, because the market's going to go up and down, but their risk profile does not need to change. So they do not have to worry about finite, 20, 30, 40-year investment timelines. I hope this makes sense. Let me know your thoughts about this below, because this is a concept that I've spent a lot of time thinking about. And it's really hard to articulate it in a video format. I'd love to know if you agree or disagree. We'll chat soon. Bye.